Ladies and gentlemen, good day and welcome to the Q2 and H1 FY'25 earnings conference call of MPS Ltd. As a reminder, all participant lines will be in the listen-only mode and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star, then 0 on your touch-tone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Rahul Arora, Chairman and CEO. Thank you, and over to you, sir.
Thank you, Doug. Good morning from New York and a warm welcome to our Q2 and H1 FY'25 earnings call. Today on the call I have with me Pratna Agarwal, who is the CFO of MPS Ltd, Sukhwant Singh, Chief Operating Officer India at MPS Ltd, Tony Alves, Senior Vice President and Head of Product Management at Highwire, which is our platforms division, Archana Jayaraj, Chief Operating Officer of MPS Interactive and MPS Europa. Pratna joins us from our corporate office in Noida, Sukhwant from Dehradun, Tony from the Greater Boston area, and Archana from Chennai. This global representation underscores our commitment to serving our diverse stakeholders across the world. Pratna will kick things off in our opening segment today by discussing our financial performance. Then, Sukhwant will update us on content solutions business developments. Tony will then follow up on the impressive progress in our platform business. Next, Archana will discuss the rapid transformation in our e-learning business. And finally, I will provide an update on the progress of AJE and Liberate and my perspective on the first half of FY'25. Let's get going. Over to you, Pratna.
Thanks, Rahul. On a quarterly basis, Q2 FY'25 showed robust revenue growth. We recorded revenues of INR 177.9 crores on an FX-adjusted basis, representing 37.42% Y-on-Y growth. EBITDA margins bounced back to 30.11% in Q2 FY'25, and overall EBITDA grew by 31.9% in Q2 FY'25 compared to last year. Reflecting on the quarter, I would like to highlight three vital strategic achievements. Our top 10 customers now contribute to 48% of our revenue, a much lower customer concentration than what we started this journey in 2012. Revenue quality is also improving, with platforms responsible for 28% of the consolidated revenue and even more impressively, 40% of the consolidated PBT. The theme of improvement in quality of revenue can also be observed through improvement in DSO days to 44. I would now like to hand it over to Sukhwant to discuss the developments of our content solutions business.
Thanks, Pratna. Revenue in the content solution business grew by 37% in Q2 of FY'25 compared to last year. EBITDA margins expanded to 38.36% as AJE settled well into MPS. In addition to the acquisition of AJE, at the journals component of our content solution business, we continue to lead the charge towards revenue growth. Volumes and revenue from our premier customer base grew because our service delivery has been among the best in the supply chain as it has consolidated. Additionally, the recently established revenue stream catering to the journal editorial office has furthered the growth momentum of the content solution business. The new offering placed us in a more strategic position in the value chain and improved the stickiness and quality of our revenue with existing customers. Our global education business, now branded as OWL, that stands for One With Learning, also saw significant growth in Q2 of FY'25. The business unit achieved a much healthier EBITDA margin and the team recorded healthy sales during the quarter, indicating that the new momentum is here to stay. Our world language content development, accessibility solution, and production services capabilities have supported the expansion of OWL. The team's effort to diversify the customer profile and the successful launch of the OWL brand in the higher education marketplace further underscore our strong performance. I would like to now hand it over to Tony to discuss impressive progress made in our platform business.
Thank you, Sukhwant. Primarily due to the acquisition of AJE, the platform business grew by approximately 67% in revenue in Q2 of FY'25 compared to the same period last year. Our collaboration with MPS Labs is going exceptionally well in content hosting and AI integrations. Product roadmaps were scheduled throughout the quarter, and they respond well to customer and market demands. Several clients are using our latest product, Digicore Pro's Sandbox implementation, toward its final iteration. Our focus is now shifting toward implementations, particularly for transitioning benchpress clients. Another highlight was the success of our business development efforts. For example, earlier this financial year, we won a new logo away from our largest content hosting platform space competitor. We are witnessing an influx of activity in new RFIs and RFPs in the platform business. There is clearly a positive perception of us in the research community, which is highly encouraging. Highwire and MPS offer the only serious independent choice in the market, as others are either publisher or private equity owned, which are not popular choices in the research community. I would like to now hand it over to Archana to discuss the rapid transformation taking place in our e-learning business.
Thanks, Tony. I'm pleased to report meaningful improvement in the e-learning business. Revenue grew by 8.8% in Q2 FY'25 compared to the same period last year, and EBITDA margins recovered to 19% in the quarter. In the India entity, MPS Interactive Systems, revenues were ahead of our internal estimates, and EBITDA margin nearly touched 20% in the quarter and are expected to only improve from here. And while the business is still not back to previous levels, it is reassuring to note that we're slightly ahead of our turnaround schedule. The business acquired 15 new logos. Collections have also improved. Average DSO is now 36 days. The teams maintained an average CSAT score of 4.5, and that has also led to recovery from some of the core accounts. The e-learning operations in Europe made steady progress. At the Swiss entity, MPS Europa, EBITDA margins surpassed all other e-learning interests. Moreover, the team is now in deep collaboration with the India entity, working on impressive solutions, and recently won a few orders with MPSI's customers. Topsim GmbH made steady progress towards its FY'25 goals. This business is now one of the most diverse business interests at MPS, with the top 10 customers accounting for less than 40% of the revenue. And the business is also expected to start paying dividends to MPS Limited from FY'25 for the first time since its acquisition in 2018. I would like to now hand it over to Rahul to conclude this opening section.
Thanks, Archana. I'll begin this section by discussing the progress of the two acquisitions. We completed the acquisition of Liberate in September of last year, a move that has significantly shaped our entry into Australia. This successful acquisition of a growing business led to a refreshing change in our modus operandi. We had an opportunity to learn much about what it takes to operate and drive a corporate learning business, which differs from our other business interests. At Liberate Learning, the top 10 accounts now includes a large banking customer that was dormant for the past 7 months due to the internal corporate development. The Liberate team has also onboarded new logos that have scaled in quick time to be in the top accounts. As Archana described earlier, picking a cue from the Liberate management team, the rest of the e-learning business has also embraced gig workers. And the positive impact has started to show, and we are bullish about the change in operating model and its positive impact on our business in the long run. The integration of AJE into MPS has been rapid and successful. We are ahead of our schedule in terms of operational and financial metrics. Our formal launch in China this past quarter, followed by a customer roadshow, has helped us develop momentum in the region. The presence in China is unique for MPS and helps us participate in global agreements with our customers, who have historically had to compromise on the preferred vendor strategy in the region. We're now closer to the most critical stakeholder in the research value chain, the funders. Additionally, the AI capabilities acquired through Curie, Lewis, and other AGE tools have tremendous synergies with MPS regarding efficiency and revenue. Our new scale is opening new doors for us, and we expect to hit significantly positive financial metrics, exceptionally high ROIC, and robust organic growth, which are potent combinations for any acquisition. After a flat EBITDA in Q1, despite a sharp increase in revenue, we have gained much ground in Q2 and we are back on track at the halfway mark, with 37% revenue growth and 15% EBITDA growth in H1 compared to the same period last year. Our scaling global agenda has gotten off to a robust start in the first half, and its positive impact is already being felt. North America is now merely 45% of our total revenue, while the rest of the world, including APAC, is 26% of total revenue. FY'25 is proving to be a year when we surpass many of our competitors in the markets that we serve, including research, education, and corporate learning. Markets have taken notice. We're being invited to RFPs and new opportunities that were previously unavailable to us. Scale implies resilience, business continuity, and future-proofing that have all become core pillars of supply chain decisions after the pandemic and the recent AI-driven innovations. Our global reach into additional markets, including Australia, New Zealand, China, Brazil, and South Korea, implies global agreements with our customers, further bolstering our optimism about the future. Let's now open the call to questions.
Thank you. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. First question is from the line of Mahesh, who is an individual investor. Please go ahead.
Hi, Rahul. Can you hear me?
Hi, Mahesh, I can hear you. Thank you.
Rahul, my first question is, how is the landscape evolving within the segments that you operate from a technology slash AI perspective?
So I'll quickly cover the overall landscape, and I'll request Tony to talk a little bit about the AI landscape. So currently we operate, while our financials are reported as business segments, content, e-learning, and platforms, our go-to-market strategy has been revised, and we attack the market as research, corporate, and education. We are viewing AI as an enabler for growth across these three particular markets, and I'll let Tony talk a little bit about how we're embracing AI. Tony?
Hello. Thank you for the question. My focus has been primarily on platforms and on content solutions, and focusing on our research and publishing landscape, which has been really evolving very rapidly with artificial intelligence and machine learning. The major emphasis has been the balance between innovation and maintaining the integrity of trusted research. The segments which are evolving are across the entire research ecosystem, but especially in the content preparation and content analysis areas. We are working on, MPS is working on solutions that address ensuring research integrity. We're focused on editorial services that address things like accessibility and content creation, including language polishing, translation, editorial preparation, summarizing content, and automated assessment creation. Chatbot support is also a growing area for us, and we're building tools into the publishing workflow process and chatbot tools into our hosting platform. I've attended several industry meetings over the past few months and have noticed that publishers have become more and more open to adopting AI and machine learning technology, while also being really sensitive to the content integrity and data privacy concerns. Their particular concern is the need to protect copyright while still letting AI organizations innovate. So there's increasing talk about licensing content to ensure that large language models and other technologies are working with certified facts. The AI and ML security and privacy standards are constantly evolving, and MPS has been adapting to those changing requirements. We've been making incremental changes while implementing artificial intelligence systems to support human-driven decision-making, particularly in the areas that I mentioned previously, and this helps mitigate the risk of relying too heavily on automated processes. I think that's a good summary of our approach to artificial intelligence and machine learning.
Thanks, Tony.
Thank you. The next question is from the line of Rahul Jain from Dolat Capital. Please go ahead.
Yeah, hi. Congrats on good performance. The first question is slightly understanding the way the business should be evolving with the new transaction of AGE. Some quarter back, it's still to complete its first year. So, are we getting a better flavor of how the current mix of business is seeing seasonality from the flow of business over the whole quarter across three segments? I think any color on that will be of great help.
Sorry, Rahul, you're coming across a bit muffled. Could you go again, please? I'm sorry to make you repeat, but I couldn't hear everything you said.
Yeah. Is this any better?
Much better.
Okay. Sorry for that. So, basically, what I'm trying to understand is that with this AG now part of the business for a couple of quarters now, do you have a better color in terms of how your seasonality shapes up across business segment now? Any color on that would be of help.
Yeah, thank you for that observation, Rahul. So I think the second half of the year has always been stronger for MPS if you go, even many years back. And whether Q3 is stronger or Q4 is stronger ends up being a debate every year, but the second half of the year is the strongest for MPS. And the softest quarter tends to be the July, August, September quarter, which is Q2. So typically, the one, your number one, number two slot is, either Q3 or Q4. The third slot is Q1, and Q2 tends to be the softest quarter. And the reason for that is, across the various lines of business and markets, the summer months tend to be slow. So July, August, September tend to be slow, both from a revenue accrual standpoint, but also from an order booking standpoint. So as a result, the quarter ends up being pretty slow. And AJ is no different, with the same similar customer profile. So in fact, anything, it's further the same setup. So I expect the same seasonality that we've had over the last few years will continue, and the second half will be stronger than the first half.
Sure. And we did quite well in terms of recouping the profitability of the business. So are there meaningful scope even from this point on a near-term basis, since we are going into a better growth in the H2? Or you think the bigger juice is already taken and we may see a small improvement in H2 on a profitability point of view?
So a lot of the efforts have already been captured, have been executed, but they're not showing up in our results because those costs have carried forward. I think margins will continue to improve into Q3 and Q4 of this year on the AGE side. I think by Q4 we'll have a stable margin profile, and from Q4 onward, essentially revenue growth, specifically B2B revenue growth, will drive the AG margin profile. But yes, we expect further improvement in both Q3 and Q4, and settling down into a nice margin profile in Q4 for AG.
Okay. Now, moving to the e-learning part of the business, we have seen a significant reduction in the headcount. Is there anything specific that caused this decline in this quarter, or this is the base where it should continue to operate now?
Again, thank you for the observation. Yes, the headcount is stabilizing at this new level. There may be some small reduction that will carry forward as part of the same initiative. Again, the execution is done, but sometimes these things take time to show up in the results. So there'll be some further minor optimization that will show up in Q3, but the execution has all been done. This is by design. It's not by accident. We are trying to follow, from the Liberate model. I'll let Archana, who is the Chief Operating Officer of our e-learning business in India and in Europe, talk a little bit about what she's doing in terms of optimizing the headcount. Archana, can you please add your comments?
Thanks, Rahul, and thank you for the question. The reduction in headcount is basically a reflection of the strategic shift in our operating model itself. And as Rahul mentioned earlier, we are consciously transitioning from a model that's heavily reliant on full-time employees to a more flexible and elastic delivery structure where we leverage contractors and gig workers. Now, this leaner, more efficient approach is effectively to enhance our operating margins, to improve the adaptability to our client needs and also volumes, while again supporting our commitment to quality and enabling more investments in future in areas of innovation and growth.
Archana, if I just extend this thought, so because there's always a constant debate on this part whether, what is a best workable model given that we want to scale. So if we are moving towards more managed training kind of a model, would you see that this is a temporary fix to the problem and we might go to a more in-house model gradually, or you think from a medium to long-term perspective, this is the optimal model of operation?
Well, we do believe that this is going to be the strategic shift for the medium to long term. It's not a short-term fix at all. We will continue to have our core team of full-time employees, and we will continue to expand our contractor base, and this will enable us to have a leaner model while being able to cater to diverse clients in different parts of the world.
Understood. And last bit, if I may, Rahul or Archana, whoever find it right. So basically on the e-learning side, given that we are making meaningful changes to the operating model and we have now a much wider canvas to offer to the clients, how you see the growth profile and margin profile of the business should stabilize from a medium-term perspective? I'm not asking for growth for this specific year, but maybe on a 2-3 year basis, should it be a 15% growth, 20% margin, whatever, something like that? Any color would be helpful.
Yeah, I think in the long run, we want the business to be as close to the average EBITDA margin of the company, which is 30 to 32%. Even if it doesn't go all the way to 32, if it goes to 27, 28, I think that would be a very strong step. In fact, this quarter itself, we actually touched 22%, 23% EBITDA margin in the e-learning segment. We had some currency fluctuation which had a one-time impact on our quarterly results. So in fact, if that currency fluctuation had not happened, in the e-learning business, we would have actually reported 22.8% EBITDA margin this past quarter. So we seem to be making very good headway from a margin perspective. From a growth perspective, currently the e-learning business is growing at that 8-9%, which is not something that Archana or I are happy about. I think our goal is to start to grow this business at 12, 14, 15% once this operating model is underway, which is very similar to how our business in Germany is growing within MPS with TopSim, how our business in Australia is growing. So even within the MPS e-learning portfolio, the German business as well as the Australian business are growing at that 15%. So we like, the rest of the business, the India entity and the Swiss entity also to grow at a similar level.
Great. I'll jump back into the queue. Thank you.
Thank you.
Thank you.
Next question is from the line of Navin Virani from Bastion Research. Please go ahead.
Hello. Am I audible?
Sir, I request you to come a bit close to your handset.
Is it better now?
Yes, sir.
Yeah. So first of all, congratulations on a strong margin recovery. So first one was on EA. Now that we have seen strong margin recovery across both these segments, that is content and platform. So just want to understand how the business looking like at EA from a margins perspective. I mean, what's the divergence between our core business and the EA piece which we have recently added? And now that the turnaround is taking place well, and that is what is given in numbers. what is the growth plan here is something which, I would want to understand a bit better from you. So that's one.
Great. Thank you for that observation. I think so from the acquired business, I'd like to point out that APAC as a region, and I'm ballparking here, is roughly now 26% of our total revenue. Having said that, from a profit perspective, the region is contributing to more than 35% of our PBT. And as you know, this expansion has happened particularly through the acquisitions of AJE and Liberate. So, if anything, the acquired businesses are adding to the margin profile, improving the margin profile of the business. I feel very comfortable sustaining this level of margin profile, 32%. We could potentially be operating this business at a much higher margin profile. Having said that, in order to drive organic growth, we have to reinvest back into the business, which includes innovation. So, a majority of our reinvestment goes into MPS Labs, which is our R&D hub. And that allows us to future-proof ourselves, but also allows us to future-proof our customers. So as a result, we're going to continue to operate this business at 30% EBITDA margin to drive organic growth. In terms of where we are, if I just go segment-wise, even though that's not how we're approaching the market, content solutions has now started to grow at about 10% more reliably. And historically, there's always been some parts of the content business that are growing, parts of the business that are not growing, parts of the business that are declining. We've always had that flavor, and as a result, the overall did 4-5% growth. But I think we have solved for a lot of issues within the content business. For example, our education business that Sukhwant was talking about in the opening remarks has made a strong comeback. So our hope is now that a lot of the issues in the content business have been cured, that 10-12% should be a reliable number for the content business to grow at. From a platforms perspective, we again expect that there should be a premium both in the platforms vertical as well as the e-learning vertical. So platforms will continue to grow, and we expect that number to be upwards of 12%. I think with e-learning, we'll probably need another 6 months or 2 quarters for things to settle in, where we are basically raising the margin profile of the business. I've learned, I've humbly learned over the last decade of running MPS that typically you have to chase one of these two things, otherwise you don't achieve anything. Either you improve the margin profile or you chase growth. And with the e-learning business, I think for the next 6 months, we're going to buckle down and improve the margin profile. And then FY'26, we're going to take that strong leap of growth, and we have very good early signs that will play out. As Archana described, we've already onboarded 15 new logos in MPS Interactive alone in the first half of the year. So FY'26 should be a big banner year for the e-learning business, where we can start to get that 14-15% growth that we've been hoping for. So to summarize, content 10-12%, platform 12-14%, and then e-learning 40-50% organic growth. In addition to that, of course, most of our inorganic activity is focused either as a platform play or an e-learning play, and that will further add to this growth.
Okay. Thank you for the elaborate answer, sir. Sir, something that you mentioned at the end of your answer about the inorganic growth, and we were also targeting an acquisition maybe in the second half of this financial year. So where are we on that? Can you share some progress?
Yeah, I hope to report something in the next quarter. I have nothing to report at this time. All I can report is deal pipeline is robust. There are multiple transactions in pursuit, so we're not dependent on one transaction. So hopefully one of those will close, and I'll have something to report to you next quarter.
Perfect. Last question, if I may. So, sir, in the content business, we have witnessed a slight moderation in headcount. So just wanted to understand, is this a part of normal activity related to cost optimization, or are we looking at a strategic move here, something which is similar to what we have done in the e-learning business?
No, this is normal ebbs and flows of the business. There's nothing extraordinary happening. Yes, we're growing. As you know, the content business, this last quarter alone, I think, ballparking here, but I think grew at 10%. But yeah, I think the headcount, obviously, efficiencies will improve over a period of time because, MPS Labs continues to invest in automation and system-based delivery. So as that automation becomes more severe and more efficient, the reliance on humans obviously reduces. So that is just regular ebbs and flows of the business and efficiency drive.
Okay, so thank you for your answers. Wishing you and team MPS a very happy Diwali and all the best for business. Thank you.
Thank you. Happy Diwali.
Thank you. The next question is from the line of Kiran from Table Tree Capital. Please go ahead.
Thank you for the opportunity, sir. Sir, a couple of questions. Of course, we watched your interview today with one of the business channels as well. So two-part question, right? One is, are we seeing any significant headwinds in the e-learning solution because the margins don't seem to improve at all, Q1, or YOY? That is one, in spite of substantial reduction in headcount. So that is question number one. Question number two, in today's interview, you said Q2 is the start of something very big. So I mean, was it just a TV channel thing or was it something that I missed? I just joined about 10-15 minutes ago. So if you have said that in the opening remarks, I'd probably request you to repeat.
No, thank you, Kiran. I'll answer the second question first, if that's okay. No, I think what I was talking about was on the interview was, I think they were pressing us a lot to share very tactical, forward-looking guidance, and we've received a lot of feedback over the past 6 months that there is no value in NPS and this feedback has been received by from the minority shareholders that there is no value in you sharing this quarterly short-term guidance with everybody. It helps the analysts and news channels, but it doesn't help the company anyway. And in fact, one of the minority shareholders went on to quote examples of various companies that have actually suffered because they shared this type of guidance. So we discussed it at the board meeting this quarter as well. And I think the call that we took was we framed a very bold vision. We seem to be tracking against that vision, and that's really the insight that we should be providing. Of course, your questions, like a couple of questions that were answered today, that help people understand the business. Of course, we should answer them, and we will answer them, but we will not be giving the tactical forward-looking guidance that's essentially just helping people run models. That's not our goal here. Our goal is to build a strategic communication channel that helps you understand the business, but also helps the company, because we get a lot of feedback from these calls and these engagements. Coming to the comment on start of something big, I think for a couple of years now, we've had an overhang in our content business because the education business has been suffering. That overhang is gone. So now the education business is performing. On the e-learning side, while you pointed out that the margins have not improved, the margins have actually improved, both at an EBITDA level. I pointed out there was some one-time, so the margins at the EBITDA level were upwards of 80% this past quarter. Compared to some lows we had previously. And I was pointing out, in fact, they would have been upwards of 22%. We just had some currency fluctuation, one-time currency fluctuation with us. So the margin profile there is improving. And then on the platform side, we're starting to acquire new logos. The business started performing. So my comment was more to do with, for the first time in a very long time, all lines of business are doing what they're supposed to do. And therefore, when all of this comes together, because you always have this story where one business does really well, another one doesn't do so well, so you basically have a mediocre outcome. And the reason I said that it's potentially the start of something very big is because intuitively, all of us that are representing MPS in the marketplace can feel the momentum. The market tells you when we get at trade shows, in customer meetings, at road shows, you're getting a feeling from the market that we are being viewed very differently, specifically after the acquisition of AJE. Perhaps it's scale, perhaps it's how diverse we are now across the various markets that we operate in. So there's of course the number side that we are now seeing in our financials, but there's an intuitive feeling that we're getting when we interact with customers and interact with the marketplace of how they perceive us. And therefore, that comment was made that, this is, we feel that this is the start of something, like Q2 is the start of something very significant, given that all lines of business are performing. I let Pratna now, who's the CFO, also come in to explain to you, because what you've seen this past quarter in the e-learning business, you've seen a recovery in EBITDA, but our PBT margins have been suppressed, and she just draw a bridge for you and explain to you what's really going on, why the EBITDA is going up, margin is going up, but the PBT hasn't gone up that significantly. So Pratna, could you explain that, please?
Yeah, thanks, Rahul. So, starting with e-learning business, as Rahul explained, we have a deferred liability for our acquisition of Liberate. And because of that, the exchange fluctuation, we had a 4.3% impact, which in value terms is almost 1.5 crores. So this impact was there in Q2, where our EBITDA margins of 18.6% otherwise would have been upwards of 22%. This was on the e-learning piece. On an overall piece, if we look at the conversion from EBITDA to PBT is impacted largely on account of two factors. One is the amortization expense on the intangible assets, which are largely because of the acquisitions that we have done in the past 1 year. So on a quarter-on-quarter basis, that impact is roughly 2 crores. And also the other impact is the reduced other income, which is 3.36 crore. On a half-year basis, if we look at the conversion of EBITDA to PBT, the depreciation impact of intangibles is roughly 4.3 crores, and the reduction in other income is 4.46 crore. So because of these two factors, the overall EBITDA and PBT conversions are impacted, other than the exchange fluctuation, where we see an impact both in EBITDA and PBT.
Yeah, so to summarize, the operating margins have significantly improved in the e-learning business, and a lot of the noise that Pratna is describing will start to kind of move out in the next 6 to 18 months. So you'll start to see every quarter, one is the operating margin itself, and the e-learning business will continue to improve, plus a lot of the noise that she's describing will start to taper out.
Got it, Rahul. Thank you so much. I have a strategy question. In terms of the goal, right, FY'28, we said 1,500 crore. Today in the interview, you said we'll reach half that number by end of this year. So we have 3 years, right, typically to double our revenues. Standing where you are, right, in terms of your 3 platforms, or you look at education, research, and training, irrespective of how you cut the cake, are you still confident of reaching that 1,500 crore mark with a 30% plus EBITDA? Is that still achievable, given there's only 3 years left, so that would involve a 25% CAGR, including acquisitions?
Yeah, it's interesting how different people look at data differently, right? You're saying, is it achievable? And I'm thinking 3 years is a lot of time. So I think from our perspective as a management team, we're very comfortable in terms of the vision that we've shared. Again, it's an aspiration. It is a vision. I think my team and I will be deeply disappointed if we didn't get there. But having said that, we're doing our best to get there. So yeah, I think it's perspective, right? You're saying 3 years. How are you going to do it? And I'm thinking 3 years. Oh, that's comfortable. So at this point, feel very comfortable with the vision that we shared.
Got it, Rahul. Many congratulations. Awesome. Thank you so much.
Thank you.
Thank you.
The next question is on the line of Krushi Parekh from Pentacle Family Office. Please go ahead.
Yeah. Hi, Rahul. So I want to understand one thing. When we have aim of having 30 to 32% EBITDA margin for e-learning business as well, is it largely as a result of cost optimization first, or also as a result of growth that we envisage over a period of time?
Yeah, I think good question. I think in fact there's 3 legs. The one is the quality of revenue. The second is the growth, and third is cost optimization. So I think so the cost optimization will pretty much be done this year, this financial year. So, but that's more tactical. As you rightly pointed out, the major appreciation is going to come from the other 2. So in terms of quality of revenue, immersive learning, and just for everyone's knowledge, immersive learning is an education method where you're basically recreating real life scenarios through technology such as simulations, gamification, AR, VR, etc. So immersive learning increasingly as a proportion of our total e-learning business is increasing. And given the premium of positioning that we have within immersive learning, it tends to be a higher margin business for us. So as immersive learning continues to become a higher proportion, the quality of revenue improves and therefore the margins will improve. So that is one factor, that the quality of revenue within the e-learning space is improving and is expected to improve. The second perspective, of course, is, there's significant operating leverage available in our business. So as long as the business can grow at 10%, we will always see margin expansion. So between quality of revenue and revenue growth, I think that will be the leap that will take us from 25 to 30%.
Okay, got it. And sticking to this corporate e-learning, how is the funnel and the budget shaping up, considering we are all reading about the layoffs and the corporate slowdown, especially in the developed market? So are we witnessing any impact on the budget of our customer base or our clientele?
Yeah, so I won't sugarcoat it. I think we're definitely having to work much harder for the same level of order book. So I think decision making is slower. Having said that, having lived through 08, 09 and other experiences like this, typically education and training actually gets a boost when there's a slowdown. So we're expecting that we're having to justify a lot on how we price things, but we are finally winning the deals. So one is typically in a situation like this, you invest more in education and training as large corporate. And the second is when you do reduce internal headcount, the work still needs to be done, right? So typically you would outsource more. And that's where a company like MPS Interactive comes in, where training is outsourced, and that creates an opportunity for us. So yes, I think between a small base that is not as affected, as well as the larger pie that's now been created, we feel comfortable. Having said that, of course, we're having to work much harder to earn our lunch.
All right, got it. Thanks a lot, team, and happy Diwali to all of you. Thank you.
Thank you.
Thank you. Happy Diwali.
The next question is from the line of Arpan Agrawal, who is an individual investor. Please go ahead.
Hi, good evening. I'm a new shareholder of the company, so some of my questions might be nice. I'm sorry about that. My first question is on the internal team structure. So there are two ways to understand a company. So one is through capability, which is platforms, content, and e-learning. The other is end market, which is research, corporate, and education. And third is where the acquisitions that we have done over the last 10 years or so. So my question is, how are the teams internally structured?
Sure. So overall, I think we are more structured functionally and geographically. So, for example, on my executive leadership team, I have David, who's the managing director of our education business, but also heads the North America region. I have Tony, who is the head of our product management and product for the overall business. I have Naren, who is the CTO and heads all of our technology. We have Sukhwant, who is the chief operating officer for our India business across content and platforms. We have Archana, who is the chief operating officer of the e-learning business, and then we have a new chief people officer joining shortly, and of course Pratna, who is our CFO. So we are more designed at an intersection of function and geography rather than segments. That allows us to be more efficient in our approach. So, for example, when Sukhwant is running the content and platform business together in India, he's able to unlock synergies between those two divisions. And that's why we chose this approach. Otherwise, we'd be too siloed.
Got it. So a quick follow-up question. So if we do an acquisition, the acquired company is not operated independently, like it's merged with the existing entities, wherever it logically fits.
Again, depends on the specific acquisition. So we are now following two routes. One is acquire and operate, which is the established route. When it's acquire and operate, typically, even during the diligence phase, I would have the business head, the CFO, and the HR head join me in the evaluation, and the pursuit of the acquisition. And then there's a second route, which is what we did with Liberate, where we are acquiring to invest in support. So in that case, we are acquiring a majority share of the company. We're making sure that the promoter group has a stub left and essentially is contributing to the overall growth of the company. So depends on the specific acquisition. If it's required to operate, it's integrated from day one, like we did with AJE. If it's required to invest in support, we follow a more passive position where only Pratna, who's the CFO, and me will be supporting that setup, potentially HR and legal as well, because we centralize the function. But other than that, they don't get fully integrated into the business.
Okay, got it. My second question is on platform. So platform segment serves all the three end markets, which is research, corporate, and education. But I also read that we are rolling up all of the platforms under the umbrella brand of Highwire. So my question is, the Highwire's website says that it serves a scholarly community. So my question is, what would happen to the offering for the education and corporate end markets if all of platforms is being rolled up into Highwire?
Good question. So the platform vertical, the way it is structured today, bulk of it actually caters to the research market. So while we have offerings in education and corporate, majority of the platform business is for the research market, and that is branded as Highwire. Within education, we of course have education offerings that are more product-centric. Our education brand is OWL, One with Learning. And then we have individual products like DigiWrites, we have Learning Planet. So we have individual education products. So there we are following a product strategy under the OWL brand. Similarly, on the corporate side, we have XR Optimus and a couple of other small offerings, which are then also a sub-brand of the EI vertical. But as of today, a large part of our platform business is focused on the research marketplace. Having said that, a lot of the acquisitions that I'm working on are a platform play either for education or corporate. So we are looking to bridge that gap, and that will probably be bridged through an acquisition.
Okay, got it. One question I have around...
Sorry to interrupt, sir. Please fall back in the queue for further questions. Thank you. The next question is from the line of Guneet Singh from Countercyclical PMS. Please go ahead.
Hi, sir. Thank you for this opportunity. So my first question would be regarding AJE. So, I would like to understand if AJE is PAT positive right now. And also, I would like to understand the scope of margin improvement that we have in AJE currently. So, in this quarter, we did about 28% EBITDA margins consolidated. So, with the kind of cost optimization or improvement efficiencies in AJE, what kind of EBITDA margins can we reach by end of FY'25? And also, sir, even though our revenues have increased by about 38% in this quarter, Y-on-Y, I see that the headcount has only increased by about 4.5%. So, is this also related to some layoffs in AJE? Can you please throw some light on that?
Thanks, Guneet. So yeah, I think from an AJE perspective, we are already PAT positive. In fact, the business is performing really well. There's in double-digit EBITDA margin already, quite high double-digit EBITDA margin. And yes, it will improve incrementally, as I said, shared with someone on the previous call, within Q3 and Q4. So we'll have a good sense of the AJE margin profile by the end of this financial year. Our goal, of course, is to, the AJE business is a split between content and platform. So our goal would be to run the AJE business at an average EBITDA of those two businesses, which you already have. So the margin profile will continue to improve into Q3 and Q4. And yes, not only are we PAT positive, we're actually running a very healthy business in AJE already. From a headcount perspective, I think there are a few things happening, both in AJE and in the e-learning business. We are relying more on outside workers, like contractors and freelancers. So some of that headcount is reducing as a result, driving efficiency and margins. And secondly, with MPS Labs' intervention in the content business, based on the automation that's getting unlocked, we're seeing a steady decline in the content solutions space in terms of the revenue per FTE is increasing. So yeah, I think this will continue to go on further as the year progresses.
All right, so got it. And sir, previously you had guided of about a 25% increase in PAT in FY'25. So if you look at right now, we are at 61 CR PAT versus 60 CR in H1 of FY'24. So I mean, are you confident of still achieving that, or would you like to revise the guidance?
We're not revising any guidance, and I think we gave an EBITDA and revenue guidance.
All right, 25% growth in EBITDA.
Yeah, and I'm not revising any guidance. Because like I was pointing to someone else that the second half of the year usually, and again, I'm not sharing anything that's not known, the second half of the year is always stronger for MPS than the first half of the year.
Got it, sir. Makes sense. So my last question would be regarding the acquisition target. So, I mean, we aspire to achieve 1,500 CR by FY'28. So, I mean, in the past, we have acquired companies which were probably loss-making or not operating at very high margins. So going forward, I mean, would we be making any acquisitions of those kind, or do we want to maintain the 30% kind of margins while achieving the 1,500 CR target by FY'28?
So from a margin profile perspective, when we look at acquisitions, we want to look at companies that have a, if we do a look back for 3 years, have at least a 3-year, over 3-year period, 10% revenue CAGR, but and a EBITDA margin of at least 15%, and then we come in and we improve the 15 to 30. That's a pure fit. But if something like MPS comes our way where we have an obvious win in 6 months, I would be opportunistic and take that bite. Similarly, like we did with AGE, right? AGE was MPS 2.0. So, and again, those type of things are, something that happen once in a decade. As of right now, we're focused on businesses that have at least a 15% EBITDA margin that we can then come in and improve from a margin perspective. But again, if something like AGE or MPS comes in, we will take that bite. But I don't have anything like that right now on my plate.
All right, sir. So basically, we are open to both kind of opportunities. Got it, sir. Thank you very much.
Thank you. The next question is on the line of Karan Kaporia, who is an individual investor. Please go ahead.
Can you hear me? Hello?
Hi, we can hear you.
Yeah, sorry. Actually, I'm facing some network issues here. So, Rahul, I have 2 questions, okay? One is regarding the currency fluctuation side. So, as our revenue is coming from different countries, right? So, can we do something on the hedging side so that we can mitigate this risk going ahead? What are your thoughts on that?
No, absolutely. I think earlier our coverage was US dollar and GBP, and we mostly were covering US dollar because that was the bulk of our receivables. As that is changing, we now have exposure to both the Australian dollar and Chinese yuan, and we actively, my CFO and I are actively working to create some protection around that we start to see from next calendar year onwards. Yes, we probably should have been more prudent in getting our act together, but this growth just came so quick, and sometimes you have growing pains in the business. This is one of our growing pains, and there are very, very active plans. We're talking to bankers already, and hopefully we will be able to book forward starting as early as January 2025, the first calendar year quarter.
January 2025, you're right?
Correct. That quarter. I'm not
I have one more question. So since you mentioned in the previous calls, right, the industry is in consolidation phase right now, right? So we are trying to gain the market share through acquisition. So the question is, our competitors are also following the same strategy, right? So I want to ask one thing. If an opportunity comes, so if they want to acquire a majority stake in our company in future, right? So what will be your plans? Would you be still keeping the majority of a stake, or how do you see that?
Yeah, I think so. Interesting question. So, no, I think from an MPS perspective and from a promoter, I can answer both questions both ways. From a promoter perspective and an MPS perspective, we are at the start, we're the ground floor of something very big. I think someone asked me on a different earnings call that, what beyond FY'28, and I think FY'28 is a milestone, right? The first milestone is you get to 1,500 crores in revenue at similar margins. Next milestone is you get to $1 billion valuation. Third milestone is you get to $1 billion in revenue. So there's a long way to go before we start contemplating any of the things that you're describing, simply because there's so much opportunity and so much optimism at the table. So we want to be on the right side of the consolidation, where we are consolidated in the marketplace, but there is no thought or consideration of the promoter group doing anything differently, because I am the only person representing the promoter group in the business. I just turned 40, so I have a long way to go. So from my perspective, the next decade is about first getting to Vision 2027, then getting to $1 billion valuation, and then getting to $1 billion in revenue. So I think till those three milestones are achieved, we're going to be at it. And then once those milestones are achieved, then we reassess. And from my perspective, the market typically, the competitors that are consolidating are the people where there is some ownership friction. Like as I pointed out in previous calls, where there's some partners don't get along, or first generation doesn't have a second generation, or a large company divesting a non-core asset. We have none of that going on in our promoter group, so there's no reason for us to consider any of that.
So it means we will be keeping. So you will be keeping the majority stake, right, going forward ahead?
Absolutely.
Okay. All right. Thanks. So that's all from my side. Thanks.
Thank you. The next question is from the line of Keshav Garg from Countercyclical PMS. Please go ahead.
Sir, I'm trying to understand that if we see our goodwill and other intangible assets have reduced from 31st March 2024 by 37 crore, but the depreciation during the half year is only 14 crore, less than 14 crore. So basically, where is the difference of the reduction in goodwill and other intangible assets?
Keshav, it's a technical question. It's okay. I'll let my CFO answer that question.
Yes.
Can you answer the question, please?
Yeah, thank you, Rahul. So basically, as you pointed out, the goodwill and intangible assets have reduced. While there is no major significant movement in the intangible assets other than depreciation, the major reduction that you see in Q2 is on account of the goodwill reduction. So the goodwill has reduced because there is a corresponding increase in the deferred tax asset. What we have done is, when we acquired AJE, we got a tax benefit for the next 15 years as per the US laws. While this was under finalization in Q1, this was finalized in Q2. And once all the filings were done, we have created a deferred tax asset of 29 crores. And correspondingly, goodwill has reduced by that amount, and the detail is there in the balance sheet. Hence, you see the reduction. Other than that, intangible, the reduction is only on account of depreciation.
Okay, got it. Sir, now the other question is that you mentioned previously about the cross-selling opportunity in AJE and also the increase in the wallet share with Springer Nature. So are we on track for both of these counts?
A very good question, Keshav. So I think that depends on how you define on track. Are we getting good body language? Yes. Are we very busy in lots of presentations, follow-ups, demos? Yes. Do I have a PO? No. But having said that, we know this research business, it takes time to build. As we've seen in our journals business, the teams have been at it, and now suddenly we are seeing some 20% growth in our journal business after work for many, many years. So I think a similar approach is what's probably going to happen. We are going to land this revenue, and then once we land it, it'll keep growing. So I am the executive sponsor at MPS for Springer Nature, so I personally am managing that mandate. My counterpart is the Chief Operating Officer of Springer Nature, so that relationship is super strong. But yeah, like I said, lots of good conversations on the B2B side for AJE, lots of good conversations on the Springer Nature side. Now, how that will convert in 2025, time will tell, and we look forward to your best wishes.
Sir, and lastly, sir, any update on the exhibition project business or Mangrove business that the orders got deferred? So any clarity on that?
So we landed a new order, which is, so we are currently in phase 1 of the order. So typically what happens is, you have a phase 1 where you're conceptualizing the experience center, and you have a phase 2 where you're executing on the experience center. So our assessment is this calendar year, we will submit our consulting report on what that experience center should look like. And then calendar year 2025, we will be executing on the experience center. So it's a very large undertaking. I don't think we have permission to disclose the customer's name, but once we do, we'll definitely disclose the name as well. It's a big marquee name in India.
Great, sir. Thank you very much and best of luck.
Thank you.
Thank you.
The next question is from the line of Pankaj Sood from Satya Wealth Advisors. Please go ahead.
Yeah. Hi, Rahul.
Hi.
Yeah. So, sorry if this question is repetitive. I just wanted to know, when do we expect our margins to go back to our previous levels?
So yeah, I think margins have already, my EBITDA margins are already at 30% this Q2, and will only continue to improve from here. I think we'll be at a stable margin profile in Q4 when the AJE business is even more settled and the e-learning business, has gone through all the changes that they're making. So yeah, I think Q2 we hit consolidated EBITDA margin of 30-odd%, and that will improve by another few percentage points by the end of the financial year.
Okay. And our previous guidance is intact, right? For FY'28, 15 lakh crores revenue, and for FY'25, roughly 750, right?
Correct. Yeah, so there's no revision to any guidance that we shared previously.
Yeah. Okay. That's it from me. Thanks, Rahul.
Thank you.
Thank you. The next question is from the line of Mahesh, who is an individual investor. Please go ahead.
Rahul, just a while ago you mentioned an order from a large banking customer within the corporate learning segment. Can you share more details on that? Is that a managed training services contract?
Yes. So thank you for the question, Mahesh. So that is a contract with it's not a contract. It's a Liberate Learning, which is the Australian company that we acquired last year. One of their customers, had gone quiet because they were going through some corporate development activity. That customer has now woken up and is now part of the top 10 customers again. Again, it hasn't gone back to the previous levels, but we're hoping that through the course of this financial year, they will get back to previous levels. So they're a large Australian bank, and yes, it's a managed services play. So we're hoping that we can use that as a case study for expansion into other regions, not with a specific bank, but with other customers.
Okay, great. One more question. So you mentioned 15 new logos in e-learning. Can you share any more details on the logos or the size of the contract or something like that?
Yeah. So all I can share is that currently each of these is really small. When I say small, I mean the work that they do with us. We typically only track new logos that do one of three things. Either they employ at least 10,000 people, or they have, their revenue is upward of $3 billion, or they're in a sector where they're absent from. So each of these 15 new logos has one of these elements. Our current engagement with all of these logos is very small. So I think that was the point that Archana was trying to make, that We've onboarded them, and now it's about how do we grow these logos within the MPS ecosystem.
Okay. Okay. If I can ask one last question. You mentioned in the last quarter about using AI as a revenue stream. What kind of progress have you made on that front?
Yeah. So I think while the scale of projects aren't as significant, we have been doing a few types of projects. So we are doing some AI consulting arrangements. We've done workshops where for corporates we are doing workshops around the impact of AI specifically for that corporate. So while these have been smaller projects, we've been doing consulting assignments as well as workshops around AI so far. So those are more on the learning part of our business. On the platform part of the business, or rather the MPS Labs part of the business, we are now a lot of the growth that's coming in the education space is coming from AI-powered workflows. So, for example, the world languages content development that I was talking about, or rather Sukhwant was talking about, and the accessibility solution that Sukhwant was talking about. While we are not selling these as software as a service, we are using AI to power the service. So again, these are good revenue generators. So in the content side of our business and platform side of the business, this is now a mainstream and a part of our core offering. On the learning side of our business, we're doing more consulting assignments and workshops.
Okay. Thanks, Rahul.
Thank you.
Thank you.
The next question is from the line of Kiran from Table Tree Capital. Please go ahead.
Hi, Rahul. Just a follow-up question, but a completely left field question. So given the advancements, given we are primarily in research, both on the content journal side and as well as Highwire, is there a step increase in research publications and research journalism because of this significant advancements in technology and biology, because of LLM, Gen AI, and so on and so forth? Do you really care, or you don't really care as long as the volume is coming in?
Yeah, I think from our perspective, the more content that's there in the marketplace, we see that as a big enabler for our business. And I always, whenever someone says, what do you think of the content business? My answer to that is, what do you think that in 5 years, will there be more content or less content? And the answer always is more content. So as long as there's more content out there, we will find a way to monetize, that aspect of enablement and delivery of content.
Got it. And then the other
Sorry to interrupt, but another nuance is, as that is happening, we've actually built a whole new business around research integrity. So this has both a platform offering as well as a content offering, where we're actually helping some of our customers, making sure that the research that they're receiving does not lack integrity. So we're kind of helping them enable that. So yes, it's also it has some short-term positive gains where we're supporting the research integrity process.
Got it, Rahul. Makes sense. Thanks. So the other question I had was, so the 1,500 to 750, the data that we currently have from 25 to 28, what percentage do you think is via acquisitions and what percentage is organic? Roughly, again, things can change very rapidly, but as of today, as you stand on the post today, how do you look at the split in terms of how much acquisition, how much organic?
60-40, 16 favor in organic.
60 is organic, 40 is acquisition.
Other way around.
Oh, okay. 60 is acquisition, 40 is organic. Got it.
Right.
Okay, cool. Thanks so much, Rahul.
Thank you.
Thank you. Ladies and gentlemen, that was the last question for today. I would now like to hand the conference over to Mr. Rahul Arora for closing comments.
Thank you for your active participation in our earnings call. We appreciate all your thoughtful questions. Your unique outside-in perspective helps us to learn and improve. I want to thank all our stakeholders for their continued support and respect. Our journey together has been truly remarkable. Wish you a happy Diwali and look forward to your continued support, feedback, and partnership, myself.
Thank you. On behalf of MPS Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.